structured work, global disorder, and regional responses. So what we do in this and because of the connection with, of course, the physical, the geographical proximity to the conflict in Ukraine. This is creating a lot of tension between Europe and US, for example. The cost of natural gas imported by US in Europe is 4 times the cost of natural gas in US. And this is starting creating important political tension, which are not good at all. That was the energy prices. We have the same story going on with grain price index. Here, for example, I'm comparing the price of soybeans, corn, and wheat, and of course, the dynamic is pretty similar as the dynamics for the fertilizer, which is one of the components, of course. This is also, all of this is due to basically to the dramatic situation we are living in Russia and in Ukraine. Now, this is part of the story, and in fact, when we consider measures of inflation which exclude energy, these measures of inflation are around half. So we have an inflation in Europe which is around between 10 and 11% in the last few months. If you consider measures of inflation of all the other goods, but energy prices, you get a 5.5%. So half of the inflation is due. We also think that the other part of the story here is back to the COVID emergency. As we all know, one of the most immediate impact of the COVID emergency was the disruption of global value chains. Okay. Now, when the COVID emergency basically normalized at the end of 2021, there was an increasing demand of goods. So that market was somehow blocked for a while, emerged. And global value chains, multinational, weren't unable to match this demand. Okay. So the disruption which emerged during COVID-19 are still there. And this is basically due to this sort of sluggish supply response to the rising demand to a prolonged history of weak investment that we had in both advanced and developing economies. These are some data on, I guess it's private investment, but in public investment, it's more or less the same story, but speaking about global value chains, of course. What we're looking at is private investment, and as you can see, starting in the early 90s, basically the Uruguay round, what you're witnessing is an important stagnation of private investment, which is more or less the same in advanced economy, which are here the blue line, and in green economy. Of course, here there is a huge dip in 2007 after the global financial crisis. So the investment that we had there were not enough to allow a catch-up, a fast catch-up of the supply when the demand was somehow liberated after the normalization of the COVID-19 emergency. Now, another characteristics of this crisis, so the first one is the asymmetry between advanced and developing economy, the strong asymmetry. The second one is the inflationary recovery, which is much higher than in other situations. The third characteristics that we emphasize in our analysis is the existence of important winners and important losers. The Guardian came out with a very important long read in the middle of the COVID emergency. It was about March 2021, showing impressive data that we have also in the report on the increase in profit, what we call extra profit, which are basic rents of the big multinational corporation. This is evident, I guess, in the story that we all know for the digital companies and the high-tech companies during the high-tech emergency, when everybody was spending time buying things on Amazon and services with on other platforms, but it's not only the case for technological platforms. So the idea is that probably more than a classic inflation crisis, what we are living right now is a distributional crisis. And part of the story of the Inflation Act enacted recently by the Biden administration is exactly this. No? We raise the taxing of luxury goods in order to curb demand for that kind of goods, which are part of the reasons for the spike in inflation. Okay. Under these circumstances, given the precise and specific characteristics of the slowdown that we are living, we do think that harking back to the kind of policy stance what we adopted in the 70s or in later decades, which is basically marked by austerity policies and on the fiscal side, by interest rate hikes on the monetary side, is a very dangerous response. Today, it's what we call in the report a dangerous gamble. Yeah, just to give you an idea, I forgot to show you this. It's that's the story of the wage, no? The spiral, this wave fixed price periods. These are the labor shares starting from the 80s going to 40 years of labor shares. And then you can see both in advanced and developing economies, the labor share are going dramatically down. Okay. And that's the other side of the story is, of course, the growth rate of the average wage per worker, which has been stagnating both in advanced and in developing economy, which is, of course, giving you a picture which is completely different to the picture that policymakers were looking at back in the 70s when the first big stagflation arrived. Okay, so what are the why it is a big mistake according to our narrative and our report? Why is it a big mistake rising up interest rate in this case? Well, because rising up the interest rate is having a dramatic impact. We look especially to what is happening, of course, and we're interested especially in what is happening in developing countries. Okay. And what we've been observing is that starting in the last quarter of 2021, of course, the first thing that we observe is that capital flows to developing countries turn negative. The first reaction that you have in situation, first in a risky situation. So we are in a slowdown, so there is a flight of savings. Yeah. But then, if the dollars becomes more, if the interest rate on the dollars and on the euros are becoming higher, of course, you are incentivized to move your resources towards Europe and US to have a guarantee about your returns, and that's what we are actually observing here. Now, that's very strong evidence that you have, but I guess it's very well known evidence. Basically, the blue line is net portfolio inflow to developing economies, while the green line is the United States dollar index. So how strong is the dollar? Okay, and as you can see, there is almost a perfect negative correlation between capital flows to developing economies and the strength of the dollar. So if my policy stance is strengthening the dollar, what you're going to observe, it has been historically so. These are data from the last 15 years, but that's an obvious chain of events. The immediate reaction is having capital flows, which have been massive, but it's not necessary to go to the detail of the data. Now, the other thing is of course, the dollar is strong. So what I'm having is that developing country currencies are becoming weaker with respect to the dollar. According to our analysis, basically we have seen 90 developing economies, the currency, 90 developing economies losing ground with respect to the dollar, and over a third of these by more than 10%. In less than 12 months, a 10% loss of the currency value, which is huge, a huge change, okay? And of course, what you have in these cases is that you try to defend your currency, so foreign reserves are going down, and the other things that you have, since the currency are weakened, is that the bond spreads are increasing. Okay, let me show some data also in this direction. These are the data of the developing economy which have been losing more during this is the period just 7 months, January, July 2022. Let me say, for the Sri Lanka, it's huge. The currency loss with respect to the US dollar is 77.8% of value, but also for other big economies of the South, like you can take Ghana, you can take Turkey, you can take Argentina, you can take Egypt, you can take Pakistan. For all these economies, the loss with respect to the dollar in 7 months has been higher than 15%. And that's the other story that I was telling you, that another things that happen is that when your currency is losing with respect to the dollar, is weakening with respect to the dollar, what's happened to your bonds is that your bonds are becoming more expensive. The interest rate that I have to pay to get money from the capital markets are going to be higher. And here I'm showing you just the high correlation which exists in all the big emerging markets between the nominal exchange rates vis-a-vis the dollar, so how weak my currency is, and the country-specific, this is a country-specific index on the bond market. So how risky are perceived the bond of this market by investors. So the higher is the value of the dollar, the weaker is my currency, the higher is the risk premium that developing country bond will pay. Okay, and this, of course, is generating further tension. Okay. This is what countries are doing, are trying to defend their currency, of course. Are trying to defend their currency not in a very effective way, but still they're spending a lot of money. They have spent, for example, in 2022, almost 380 trillion of US dollars or foreign reserve in the attempt to arrest the depreciation with respect to the dollar, which is almost the double that they receive in special drawing rights. We do think that one of the most effective things that Washington institution, Bretton Woods institution did from a monetary side during the COVID emergency was the extended use of special drawing rights. Still, the great majority of these special drawing rights, around 65%, has been given to advanced economy, and still what developing countries pay from their own reserves to defend their currency in the last 12 months is almost the double that what they receive in SDRs from the IMF. Okay? And this is leading us to ask more special drawing rights for the years to come. Now, of course, this is a perfect storm for developing countries. The currency are weakening, the interest rate premium that they have to pay is higher because the bond spreads are going up, capital flows are going out, there is a very strong flight to safety and flight to dollars. So, of course, the condition of the debt condition of many of these countries are worsening. Why? Because of the two things. First, to service my debt, to refinance my debt, I will have to pay higher interest rates to match the interest rates of the Fed and the Federal Reserve, and increasing perception of risk on my markets. And second, in many of these countries, part of the debt is denominated in dollar, and this is a direct effect. If my currency is weakening, the price that I have to pay is higher. I think you see. Okay, here the link. And here, it's not non-surprising evidence that we have is, of course, a continuous increasing cost in servicing public debt in developing countries in basically all the different categories that we have in all the regions of the world. And here are the most evident example. These are the top 20 countries in terms of increase in servicing cost and servicing cost on public debt and publicly guaranteed debt in these economies. You can forget about Somalia's failed state, we know, but big economies like Sri Lanka, like Angola, are in a terrible situation. And have been witnessing an increase in the cost of debt of more than 50%, or servicing the debt of more than 50%, which is, of course, a very worrisome evidence. Overall, it's easier this way. Overall, according to our estimation, the effect on financial markets of the hikes in the interest rate of Fed and European Central Bank could cost around 360 billion in future income loss to developing countries. Now, so the question is, and here I come to the last part of my presentation after having documented the slowdown and studying why we think the different crises have been not dealt in an adequate way by policymakers in advanced economies. The last part of the story is we try to shape and to discuss and to describe the building blocks of an agenda to restore this idea of resilience and fairness that we liked that much when it was proposed 2 years ago, but we put it in the drawer when rain came in the form of inflation and in the form of stagflation. And the idea is that in order to recover this kind of fairness agenda and accompany the developing countries on their development path, what we need to do is revert the course of action and adopt a more pragmatic approach along several lines. One important thing to do is, given that inflation spirals, it's coming mostly on the energy and commodity markets, first best policy reaction is trying to strategically control the price in these markets. We also see that one important evidence during this inflation emergency is what I said before. It's more of a distributional emergency than an inflation emergency per se, in the standard sense of inflation emergency we are used to think ahead. So we do think that windfall taxes and antitrust measures to control the dominant position of many markets for big multinationals are extremely important. I think what is happening now in New York, a couple of things happen very important. I think from the point of view of developing economies. And I'm a bit biased because I'm working for Amsterdam in this analysis in the last week. The first one at COP27, this has been a bit dismissed by the Western press, but I think it's important. This damage and loss fund that has been created despite the initial opposition of US and Europe and the continuous opposition of US, it's a good news, and has been obtained because the G77, the big developing economies, have been acting all together for once. And the same thing is happening now in Europe on international taxation measures on multinationals. So there's something that is happening. This probably leads me to the idea of strengthening South-South cooperation, which is another of the pillars that I think it's important to change in global governance. The third thing that we think is extremely important are social measures to support more vulnerable groups, including the lower wage workers and the households. I was doing some work during the emergency, and it's incredible how the impact of the crisis has been asymmetric not only between advanced economy and developing economy, but also within both advanced and developing economy. Certain categories, weaker categories, have been paying a much higher price coming from the lockdown and restrictive measures which have been implemented in basically all over the world and are still implemented chiefly in China. We think that apart from these measures, we also need a strong support from a multilateral point of view for liquidity and policy space. So increase of ODA, larger and fair use of special drawing rights. I mentioned this before. We welcome the increased access to special drawing rights launched during the emergency by the IMF. We think that more should be done in this sense, and we think that probably there should be a more equilibrium between the special drawing rights assigned to develop and to developing economy. Okay, and probably thinking to the idea of an hedging mechanism to deal with exchange rate volatility, which is very dangerous for weak economies, would be also a very welcome progress. We also need, and that's a thing that we are discussing since a while, that much shall be done in terms of a better framework to help debt destruction, given the worries which are increasing on the debt. We have the AGA now going on in Geneva on debt, and there is a lot of demand by part of the European countries to receive further support. And then that's another area which we cannot talk about everything, but I think it's extremely important. This is our neighbors at the WTO. I think that we need a truly development agenda. The Doha trade round was launched and described as a development trade round, but there are a lot of tension between developing economy and advanced economy because these developing trade round have never really materialized. I think that here there are three areas which are extremely important. The TRIPS and reforming the TRIPS. What it has been done during the COVID-19 on pharma was by far arrived too late, and it is not enough. And more important, it is the extension of access to patenting and license should not be restricted to pharmacological products. The second important area for which there is a huge discussion at WTO going on is on digital. Okay, the two pillars here are data sovereignty. There is a huge battle between India, China, and US, and the idea is that if we want at least the European economies, is their position at the negotiation table is this one. If I need to grow my own digital system, like China did, for example, I need to have data sovereignty. I cannot give up my data to the digital giant who's operating in my country. If you look at something I presented at WTO Public Forum a couple of years ago, but if you look at the map of the greatest multinational or the greatest companies in the digital sector, you have the Silicon Valley on the one hand, and you have China on the other. There is nothing else. Yeah, there is nothing else. Why? Because of course Silicon Valley is where this company started, and then they got there. There is tons of reason why if you start first, you have more advantage. You have huge first mover advantage, scale economies, network economies, asymmetric operation of the market. But then the only country to manage to match somehow the size of digital companies into Alibaba, to Baidu, now to TikTok, which is all our politicians here in Italy on TikTok, was China, because in China was the only country which data sovereignty was defended. While in Europe we did not that, and in Europe we did not build any, we don't have any digital giants. So that's another important issue. The other is digital trade. We have a moratorium on digital trade, which is still there since now 15 years, and each 2 years they renew the moratorium. The moratorium on digital trade tariff means that whatever product I import digitally, so I'm buying a song, I'm buying a movie, I'm paying the right description to Netflix, whatever I do, I don't pay tariff. Okay. Of course, these 15, 16 years ago, the volume of these goods was very low. Now it's huge. And the distribution of the cost and benefit between advanced economy and developing economy, it's also clearly weighting on one side or the other. So of course there is a huge discussion here. The third is defending the spatial and differential treatment. This idea that the certain benefits that have been granted to developing economies are no more actual because they already developed. It's an issue, and it's another issue which is important there at WTO. Finally, and that's my last slide. I think that more or less, how much? 2 minutes, 1 minute?
2 minutes.
2 minutes, okay. I told you that more or less that is. Took a lot of slides, but many of them are just to support. The other thing, it's extremely important, especially discussing these with you at OEET. It's very important. We think that we need an region in the South in the form of what we define developing region. One, we didn't have time to discuss also about that. But part of the work that we do is also, already before the COVID-19 emergence, you have some mega trends that, and motion and digitalization were pushing in that direction, which were, all the idea of the shore, or what Margaret Yellen a few months ago in May declared and called France shore. Okay, so instead of having these huge value chains parts of the world, what we do is that we outsource, but we outsource close to our house. We create some sort of trust clubs, which is becoming even more important now. Why? Because first, with COVID, what I have is an increasing demand of dependability and resilience in advanced economy. So I want to be sure that it is around. So probably if the chip is not produced by a Taiwanese firm operating in China, where you close everything because you have the zero COVID policy, but if I manage to do it close to home, this is going to be safe, and it is even stronger if you think to pharmaceutical products, but also because, of course, with the conflict in Ukraine, the tension between West and West, West and East, North and South of the world are increasing. So trust clubs are becoming more important recently in countries of the North, unfortunately. So we think that we should do more in terms of regionalism between the country of the South, and we think that there are the 4 pillars around which this idea of development regionalism should be articulated. Is the idea of providing a stable macro and financial framework to support the creation of productive capacity, and this can be done implementing and try to implement mechanisms to avoid exchange rate instability. Here, the idea of a fund to support currencies which are more in difficulty, and to foster long investment. Here, for example, the idea for South-South clearing unions can be helpful. The second pillar is the provision of regional physical infrastructure. Despite all the criticism that this can, of course, can give rise to discussion, there are always geopolitical interests, but the idea of the Belt and Road Initiative goes along this line. The provision of physical infrastructure at the South-South level. In terms of industrial development and trade, the idea of supporting regional value chains. Personally, I've been working closely with many governments in the southern of Africa on this, and that we do think the regional value chains are important. We can discuss later if you want to discuss the trade agreements that you need to make this happen. The fourth area I was mentioning before, how important can be the digital world for developing economies. It is already affecting them a lot because of digitalization, what's happened in the last 15 years, if you look to this data, we're working a lot with Groningen University, the award input-output data set. What you've been observing in the last 15 years is that along the value chain, those tasks which are pre-production and post-production, that is the research and development, the design of the product, the logistics, the marketing, are getting much more value. Okay, while fabrication and assembly are getting less and less value. Okay, so there is a change in the distribution of value along the chain across the different tasks, and the tasks which are pre-production and post-production tasks are usually the headquarter tasks, the tasks that you do in the Silicon Valley rather than in China or in Thailand. Okay, so it's extremely important to build regional data economies. We think that the model of the European Union of the digital market to be a nice model to be replicated maybe in Latin America East Asia or in Africa. And two are here the main important lines within kind of first the regional share of data. I was speaking about data sovereignty. Data sovereignty is good, but if you are China, you have a lot of data. You have 1,400,000,000 data there, no? But if you are, I don't know, Dominican Republic, or if you are Togo, the things are different. So in order to strike a balance between not giving your data to the big giant in US and in China, and keeping a space for your development development of apps to work and thrive, it's creating a regional space, in which you have data sovereignty, but at the regional level. And the other idea is, which is especially important, I guess, in developing the economy, facilitating regional cloud computing. In many developing economies, in Africa and Latin America in particular, you have this missing middle part. You have big firms, very small firms, you don't have medium firms, because a lot of small firms have problems in rising up, okay, because of the cost. So productivity remains very, very low. That's the first result. Providing regional service of cloud computing can cut the cost for these firms and can somehow add some of these firms to arise inside and therefore affect productivity.
Thank you very much.
Thank you very much.